Barry, I want to get your take in terms of what we did hear from U.S. Fed Chair Jerome Powell 2 weeks ago now, or March 16th, I think the date was, when we heard from the U.S. Federal Reserve and what the market was expecting. Because the market's actually been performing quite well, despite that they seem to be absolutely on the path for more rate hikes. I mean, I think he gave a little bit of room to be nimble. I think he basically said he doesn't have to raise rates every meeting. But that the path is to raise rates. Do you think that they will raise rates? Will they do it too fast, and will they cause a recession?
I think they are going to raise rates too fast. It remains to be seen whether they cause a recession or not, but that probably doesn't matter. It's whether the markets build in a recession that really matters to people that are investing and have money exposed to financial markets. But I wouldn't read too much into the equity market activity since Powell spoke 2 weeks ago, because I think there's pretty strong month-end, quarter-end flows that are driving equity prices here. And, the stock market was down over 10%. He came out and said that, and there is a lot of window dressing going on, which has driven stock prices back up to close to flat on the year.
Yeah, and the stock market's rebounded quite nicely. But so I guess so that everybody understands, when you talk about the money flows, it's because the market had pulled back so much. If you're an index fund, you need to buy more equities to balance out your percentage equity versus fixed income. Is that what you're talking about?
Yeah, and I think that you'll tell in the next couple of weeks. I'd be very cautious on stocks in the next couple of weeks.
Why in particular over the next couple of weeks?
Well, because I think it's up. A lot of stocks are up 20% the last 2 weeks, and it's quarter end, and we'll start to see what the bond market starts. So the bond market has rallied too. And if bond yields start to go back up, equity prices are probably going to struggle as well.
Okay. And so, Barry, when we think about oil going to maybe 150 or alternatively down to 80, walk us through what that scenario looks like for the financial markets and inflation.
Well, certainly if it goes to 150, that means, we've got 8% annualized CPI. That means it could go as high as 10%, and more importantly, probably last longer, the way the CPI calculations are done. And so if the CPI rate goes to 10% and doesn't start falling for another 6 to 9 months because of oil, then the Fed is forced to have a more hawkish policy, and pretty much ensures that they will overhike and increase the risk of recession significantly.
And what about the alternative? If in fact there is some type of reprieve in the price of oil and maybe it goes back down to 80, how do you see that impacting the financial markets? And importantly as well for our viewers, the economy, as everybody looks to kind of plan their future.
Yeah, well, then the outlook is probably much more benign. If we do have a recession, it's likely to be shallow, or we may avoid it, because the market would probably prove to be right that the terminal rate and the Fed funds rate's around 2.5% instead of 3.5% or 4%, which brings in dramatically different outcomes for the equity market.
And what's your sense right now in terms of the health of the U.S. economy? We'll start there and then we'll talk about the Canadian economy as well. But just in this segment, U.S. economy, what's your sense?
It's pretty good right now, but it's slowing. And you've got an environment where you've got a hawkish Fed, you've got inflation at 8%, oil above $100, high equity multiples, tight credit spreads, an inverted yield curve, supply chain problems, margin pressures, and a lingering pandemic. Those are all the negatives, and the positives are a much shorter list. So based on history, you should be defensive right now.